They woke up to a world that still looked the same, but nothing cost the same. Oil tankers drifted offshore, waiting for orders that never came. Credit lines froze. Screens flashed red from Singapore to Sao Paulo. And what died in the night wasn't a country or a bank, but an idea that the dollar would always be there. This is Hidden Finance, where we decode the money behind power. If you're new here, welcome to Hidden Finance. If you've been with us, you know that beneath headlines and closing bells lies the real machinery of the world. Together, we peel back the stories your textbooks skip and the risks most people never see coming. Stay with us as we trace the rise of the US dollar, the fault lines beneath its throne, and the uncomfortable truth about what a global reset might really look like. Let's go back to where the promise began. History's reserve currencies are portraits of their empires. The Venetian ducat, the Dutch guilder, the British pound, each reigned when its issuer controlled trade routes, technology, and trust. But money is a network, and networks are conservative. They prefer momentum over revolution. To displace a currency, you need more than ambition. You need bigger, deeper, safer markets, and a court system everyone believes will treat foreigners fairly. When the 20th century cracked open, one nation was poised to offer exactly that. In 1944, with Europe in ruins and Asia in flames, delegates gathered at Bretton Woods and built a new order atop the dollar. The deal was simple and radical. The U.S. promised to exchange dollars for gold at $35 an ounce, while others promised to anchor their currencies to the dollar. The World Bank and the IMF were created to stabilize a world clawing its way back from catastrophe. It was a system engineered for a scarred age. Tight capital controls, disciplined inflation, and one country willing to act as lender of last resort. From the shattered railways of France to the shipyards of Japan, rebuilding was financed in green. The 1950s and 60s were a miracle and a problem. Dollars poured across borders to fund trade and investment. But those flows created a paradox the Belgian-American economist Robert Triffin warned about. What the world wants from a reserve currency, plenty of dollars, eventually undermines faith in the issuer's discipline. Offshore banks invented the euro-dollar market to park and lend dollars beyond U.S. regulations. Foreign central banks began to accumulate claims on the Federal Reserve. And as American deficits swelled to finance guns, butter, and the space race, the math behind that $35 promise started to bend. In August 1971, President Nixon cut the thread. He closed the gold window, severing the convertibility promise and unleashing a new age of floating exchange rates. Many thought it would be the end of the dollar's primacy. Instead, something else happened. Markets voted for the deepest well. In 1974, a quiet bargain with Saudi Arabia helped cement the Petrodollar. Oil priced in dollars, surplus dollars recycled into U.S. Treasury bonds. The dollar no longer wore a golden necklace, but it wore armor made of habit, liquidity, and the promise that anyone could get in or out, day or night. Through the 1980s and 90s, the dollar's story was one of muscle and magnetism. The Plaza Accord helped rein in an overvalued dollar, globalization took flight, and Wall Street built the largest, most flexible bond market on Earth. Crises tested the system: Mexico in 1994, Asia in 1997, Russia in 1998, and each time the world learned a painful lesson. In a storm, you don't sell the raft you're clinging to. Nations that borrowed in dollars discovered original sin, the peril of debts in a currency you don't control. The dollar wasn't just a currency, it was the operating system of globalization. Then came 2008. The mortgage bubble burst, the banking system froze, and a global dollar shortage exposed something profound. When dollar funding evaporates, everything does. The Federal Reserve extended swap lines to the Bank of Japan, the European Central Bank, and others becoming, for a moment, the world's central bank. That crisis didn't dethrone the dollar, it fortified it, because the only institution with the balance sheet and the legal authority to end the panic was in Washington. The message was clear: if you trade in dollars, the US will supply dollars when it matters most. But the years after 2008 sowed new doubts. Quantitative easing swelled the Fed's balance sheet. Zero, and then near zero, interest rates bent the yield curve. In March 2020, as a pandemic slammed the brakes on everything, even the U.S. Treasury market, the world's safe asset, briefly trembled. The Fed reconstructed emergency facilities and reopened swap lines, steadying the ship. But the episode etched a memory. Even the deepest markets can seize. And in 2022, when Russia invaded Ukraine, the West deployed finance as a weapon, freezing hundreds of billions of reserves and ejecting Russian banks from key pipes. A deterrent to aggression and a wake-up call to countries wondering what money means when it can be switched off. By the early 2020s, the data told a subtle story. The dollar still touched nearly 9 out of every 10 foreign exchange trades and remained the most used currency in cross-border messaging. Yet its share of global reserves had drifted down from roughly 70% at the turn of the century to around the high 50s. Central banks bought gold at their fastest pace in decades, a quiet vote for self-insurance. China expanded its network of swap lines, promoted RMB trade settlement, and piloted cross-border digital currency experiments. Meanwhile, the euro refined its pandemic recovery architecture, and the Gulf states flirted with multi-currency oil pricing. So what would it mean? The day the dollar dies? Not a meteor, not a headline. It would be a loss of confidence that compounds like interest. It could start with arithmetic, deficits that grow faster than the economy, interest costs that crowd out everything else, political brinkmanship that turns the debt ceiling from theater into accident. It could come from success elsewhere. A critical mass of commodities priced in non-dollars, new payment rails that don't need New York, a rival bond market big enough and safe enough to absorb global savings. Or it could be an accumulation of small fractures, the kind that don't matter until they suddenly do. Imagine a weekend in which a rating agency downgrades U.S. debt again, citing political paralysis, and a large treasury auction fails to clear at normal yields. In Asia's Monday morning, a handful of sovereign wealth funds quietly sell treasuries to cut risk. Yields jump, then jump again as dealers, short of balance sheet, step back. The cross-currency basis widens. Dollar swap costs surge. Corporate treasurers, feeling the ground move, hoard cash, cancel share buybacks, and draw on credit lines just in case. From there, the plumbing starts to groan. Letters of credit that grease global trade get repriced or pulled as banks reassess counterparty risk. Commodity traders who live and die by short-term dollar funding face margin calls that force them to unwind positions. In the repo market, the heartbeat of collateralized lending, haircuts on treasuries rise, forcing leveraged funds to dump bonds into falling markets. What was safe becomes, for a moment, expensive to hold, and price becomes a rumor more than a fact. Policymakers would not sit idle. The Fed could resume large-scale purchases, restart or expand swap lines, and open special facilities to take pressure off money markets. Treasury could consider buybacks to smooth liquidity, or, in extremis, prioritization of payments to avoid technical default. Each action would buy time. Each would come with a cost. Easier policy might stabilize the system, but at the risk of stoking inflation if the crisis is rooted in confidence rather than cash. Tightening to defend the currency might steady the dollar, but at the price of recession and market turmoil. For households, the abstract becomes intimate. Mortgage rates spike, home sales stall, and retirement accounts shrink. Import prices rise as the dollar falls, lifting inflation just as growth fades. Companies with foreign revenues get a temporary translation boost, but those reliant on imported inputs struggle to price contracts. For small businesses, credit dries up, not because they did anything wrong, but because their lenders are trying to survive a storm that began far above their heads. The rest of the world would feel the tremor in their bones. Emerging markets that owe debts in dollars could see their currencies slide and interest bills explode, forcing austerity or default. Some would turn to the IMF. Others would turn to their neighbors, drawing on regional swap lines or barter arrangements. China might step in with RMB liquidity to friendly countries and settle more energy trade in its own currency. Europe would face a bittersweet choice: accept safe haven inflows that push the euro higher and hurt exports, or intervene to smooth volatility and risk its own credibility. Would oil be priced in a dozen currencies? Possibly, but pricing is only part of power. The deeper question is collateral. What do global investors trust so much they'll hold it at scale in good times and bad? The U.S. Treasury market's depth is hard to replicate. It took a century of law, habit, and crisis. Tested infrastructure to build. The euro area has made strides but lacks a single sovereign issuer. China has scale, but capital controls and governance questions deter many. A true dollar death would require not just a rival currency, but an entire rival ecosystem, legal, financial, and political, that global savers can bet a generation on. There's another, more likely way the story unfolds, not with a bang, but a reset in slow motion. More trade gets invoiced in local currencies where practical. Multilateral payment platforms reduce dependence on a single correspondent network. Central banks keep trimming dollar reserves at the margin, adding gold or diversifying into a basket of sovereign bonds. Stablecoins, tokenized treasury funds, and central bank digital currency pilots quietly rewire cross-border transfers, making the dollar both more programmable and less monopolistic. The dollar does not disappear, it shares the stage more often. Underneath the headlines are the enduring pillars of reserve status: economic scale, military reach, the rule of law, deep and transparent capital markets, and political stability. The United States still commands extraordinary advantages across those pillars. Its universities attract global talent, its courts enforce contracts, and its markets adapt at speed. But those pillars can erode from within, through fiscal indiscipline that keeps compounding, through polarization that makes long-term planning impossible, and through the careless weaponization of finance that teaches others to build around you. Dominance is not a right, it is maintained. A more resilient future is possible, and more believable than the apocalypse. Treasury market plumbing can be strengthened with broader central clearing, enhanced dealer capacity, buybacks that smooth maturity walls, and all-to-all trading that doesn't depend on a handful of balance sheets. Fiscal policy can bend the curve by aligning taxes and entitlements with demographics and growth, and by investing in productivity, energy grids, AI infrastructure, ports, and people. Migration policy can tilt the math of aging in America's favor. And the Fed, in partnership with global peers, can refine standing facilities that supply dollars in a crisis without turning every drizzle into a flood. Look back for a moment to the last great transition. The British pound did not lose its crown overnight. It took 2 world wars, a depression, imperial retreat, and decades of capital controls to fully pass the torch. Even after Bretton Woods, the sterling area lingered as a vestige of past power. The dollar's death, if it ever comes, is more likely to be a metamorphosis, from monopoly to plurality, from single anchor to shared moorings. The more carefully that shift is managed, the less damage it does. For investors and citizens, the lesson is not to panic. It is to prepare. Understand your dollar exposures, your debts, your income streams, your supply chains, and plan for both a stronger and a weaker dollar. Diversify where you can, in assets and in relationships. If you run a business, build the ability to invoice and hedge in more than one currency. If you run a country, build local capital markets, nurture the rule of law, and design safety valves, swap lines, reserves, and trust. And what about the phrase we began with? The day the dollar dies? Here's the truth. A currency is a claim on a future. The real risk is not that the world wakes up one morning and abandons the dollar out of spite. It is that we, through neglect, make that future smaller than the promise we've already sold. Systems reset when stories stop convincing. To keep the dollar alive, the story must be earned. Again, the dollar's fate is not written in the stars. It's written in budgets, ballots, and the boring brilliance of financial plumbing. Prepare for a world with more than one center, and demand the reforms that keep the American center worthy of its size. If credibility is the coin of the realm, then the real global reset is this: rebuilding the trust that makes money more than paper and code. Because in the end, empires don't lose reserve status to enemies. They lose it to indifference. If this journey reframed how you see money, stay with us. This is Hidden Finance. We make the invisible visible, we connect the dots history hides, and we tell the stories markets only whisper. Subscribe, follow, and share so more people can navigate what's coming with clarity instead of fear. Until next time, keep your eyes on the plumbing, your mind on the narrative, and your trust in what's earned, not assumed. Hidden Finance, where the world's biggest moves are never a surprise.